Hello and welcome to the Investor Master Series. My name is James Boyd. Today, April 15th. It's always a special day for many of us. A little joke there. Hopefully that's already done and dusted and you're ready to get to this next year. My name is James Boyd. We've got Barbara Armstrong in the chat. We welcome her. And when we talk about the Investor Master Series, we talk about stocks, we talk about technical analysis, fundamentals, option strategies. The goal is to bring it together. And we could also include topics like portfolio management. So that's what we'll do, and this is really designed to really be more of an intermediate to advanced class. If you're a beginner, doesn't necessarily mean you can't learn something. Just might need a couple more times and some questions answered to make that process progress that you really want. And also kind of see the process that we like to follow in our examples. Now, just real quick as we get started, remember when we talk about stocks, okay, investing has risk. Also understand that does mean the potential for loss of principal. When we also bring up options, we don't do super advanced options. Strategies like covered calls, cash secured puts, verticals, collars, married puts, something that is typically related back to stock ownership, okay, or the potential stock ownership. So when we talk about stock options, remember that options carry a high level of risk and are not suitable for all investors. So understand that we might talk about that. It's up to you to decide if that's something you would consider for yourself. Remember that also, as we talk about examples, they will be done in the Paper Money software application of the Thinkorswim desktop. And also remember that short options, here we are in America, we're trading American markets. So when we talk about selling puts or short options or selling calls, those could be assigned at any time up to expiration, regardless of the in-the-money amount, okay? So that just means if we had a covered call, someone could take those shares prior to expiration. If we shorted a put or did a cash secured put, we could be the buyer of the shares prior to expiration, okay? That's the difference between American and European style options. Now, coming up, if you go to schwab.com/events, if you go to that webpage, you'll see some upcoming events in which you could go to in person. Barbara was actually just in Detroit over the weekend, and she was at that 2-day event. And we're going to be in Denver next, May 2nd and 3rd. First day technical analysis, second day option strategies. We will also be in Anaheim. The AOS is the Advanced Concept Workshop or Advanced Option Workshop, the 30th and 31st. And then we're going to be on a 1-day type of event in Miami, the JW Marriott Turnberry Resort. Now, how much does it cost to go? Well, it's really more of a cost of time, right? If you're a Schwab client, you can go for free. There's limited seating. Now, that's not like a sales pitch. You know, if the room fills 500, you know, there's 600 people, we can't have 600 people. So there is a limited event, limited amount for each event. So just make sure they do fill up. So that's why we put the schedule on for the whole entire year so you could plan in advance. Now, today what I want to do is I want to talk about kind of just where we are in terms of market conditions. Now, if you call me Mr. Optimistic at the end of this, fine, I'll take it. Now, and we'll kind of talk about what are some of the risks that are still lingering in the markets. We'll show that as well. We're going to also talk about heavily today current positions. We got expiration on Friday, and I need to talk about some positions that are still going, but also some positions we might look to get out of. And I think that's sometimes the hardest point to consider is when to maybe just get out of positions that aren't doing what you want them to do. And then also we're going to talk about some new examples as well. So first off, let's go ahead and just take a look at a couple comments that I just want to kind of make. I cannot pull up the charts, okay? But I just want to kind of say that if we looked at gold is still holding in there, okay? Gold trading at 32.34, up 8 points, 0.25%. Gold is still holding. We said before that gold has really been acting like a sector, maybe some safety net, if you will, that is not broken down yet. Second, we actually saw Bitcoin actually trying to get a reversal. Bitcoin very sensitive to risk, and Bitcoin trying to get a little reversal. Keep an eye on that. Interest rates, that is a chart we could pull up. If I pull up TNX CGI, okay, colon CGI, what you're going to notice is those rates after on what, Friday? That was a brand new high on Friday in the shorter term. Rates kind of backing down a little bit, okay? So usually when rates are lower, present value or potential stock prices might be higher. Obviously, there has to be some rate, okay? But the biggest thing is you just don't want it to go shooting to the upside. Higher rates typically mean lower potential stock prices, okay? As it's pushing down intrinsic values and what those stocks could be worth. Now, so that's something to kind of keep an eye on. Now, we said before that it wouldn't be unthinkable that if those rates stayed between maybe 4, it says 40, but it's really 4%, because we're talking about the 10-year, and 45 or 4.5. We don't know what's going to happen, but if we were kind of thinking what might happen the rest of the year, it wouldn't be surprising if we stayed between 4 and 4.5%, okay? Now, that plays into real estate, home builders, so on, utility stocks, staple stocks, and many other things as well, and we're going to keep an eye on that. But that's the biggest thing that we saw in the last week or so is shooting up on interest rates, and that usually can cause some areas to drop pretty aggressively, but it's also related to the US dollar. Speaking of that, euro still strong, pound still strong, Swiss franc, okay, still strong, Australian dollar trying to get a little move, and the yen, fear the yen, okay? Those are still getting a push from our Friday discussion. Now, speaking of actually equity markets, you see that, well, I have to, okay? I got to have a little fun here. I can't just be, and I don't want to have all the fun by myself. So yesterday, and how many of you remember the show, The Price is Right? Come on down, okay? Well, yesterday I said bullish investors feeling right now on the VIX. Well, let's go ahead and take a quick look at this. Now, remember, if you're a bullish investor, you don't want to see this VIX going up like this, okay? And if we take a look at this, you want to see that short-term moving average go red. It did. When did it do that? On the 10th. When did it actually start to go further and rally to the 10-period moving average and rejection right at the 10-period moving average, sold off even further? Bulls like that. Little gap down in the morning on Monday. And then you got a cross on the 11th, okay? Now, does that mean that, as the VIX goes down, the market is trying to recover back up, okay? Speaking of that, last week, our topic when we talked about snap back rallies, okay? And there was a reason for that. We've seen this before, okay? Where you have sell-offs and you can get some pretty hard snapback rallies, and some stocks, more than others, have done a fairly decent job. So remember, if we're talking about, I think if we're all having a discussion, it wouldn't be unthinkable to think that the VIX might be a little bit more elevated given some of the things on a macro basis. Now, okay, so I'm not going to take it any farther from there, okay? You know what I'm talking about, but some things domestically and internationally have been on some pins and needles. So is someone thinking that the VIX could go back down to 15? Probably some things need to be fixed and matted down, probably until maybe the VIX can come to that level. So if we were kind of thinking what might happen over the next month potentially, which is why you invest, you got to have a forecast or an idea of what might happen potentially. Well, probably VIX a little elevated. The reason why I put 20 and 25 there is this is probably where maybe if we kind of got some normalization, the VIX might be a little bit more elevated. So potential selling strategies might be a focus for some investors, okay? Now, when we take a look at the SPX, okay, and you go look at the SPX, the line that we've been talking about over the last couple of days is really that 61% fib level, okay? Now, today we were up to about 54, 51. Now, I'm going to take the words right out of the mouth of Lisa Jack. I liked it when it was up higher. Oh, man. Now, if you take a look at this, here we are at 61, and clearly yesterday was the red candle day. Significance? Well, if we get another close above the high of the low day, you gotta trade or close above where we were yesterday. Now, significance. Where did this market fall apart? This market fell apart right at 5,500. This is where the wheels fell off the wagon, and then the wagon just coasted to the downside. What you're now going to notice is if we can get above 5,500, okay, we ain't out of the woods yet, okay? We get above 5,500, this is where this a lot of negative gets soaked up, okay? So this is kind of that damage. After you broke support, that's what we've been going through. As investors are watching this, they're really watching, can we get above 5,500, okay? Now, so if we said we're a bear, not out of the woods yet, but the one thing that we have to say that we don't like if we're a bear, we got above the 50, we're staying up near the 61, we're not selling off yet. If there are sellers, there's not enough sellers so far to smash the price higher. The longer you stay up near an area of resistance, potentially the greater chance you have that it could break above that line. So if we're bears, those are kind of things we don't like. If we said, what's the pro about the bear? We haven't gotten above the 5,500. All right, now, just real quick on the NDX, what you're now going to notice is it looks the same, okay? The level on that NASDAQ, 19,268, okay? Now, question regarding kind of this, someone said it's like a ribbon, okay? So let me just share this just real quick. This is just 2 whole moving averages, and it has some shading here, okay? Let me go ahead and put this right in the chat. And what I'm going to do is, how do you put it on, okay? So at the very top right, we're going to go to Setup. We're going to go to Open Shared Item. Okay, so let me just kind of pause for just a sec. Going to go to Setup, Open Shared Item. Click on that. And now what you're going to notice is, there it is. Okay. Show that one more time. Setup, Open Shared Item, copy and paste. What do you copy and paste? What's actually right in the chat. Okay, now when I do that and say preview, okay, and then I just click on import, what you're now going to see is going to zoom in, gives a little chart. Now, once you have that chart, can you save that? We're going to go to style. We're going to go to save style. Now, the biggest thing is the comment also really came from advanced decline line shows buyers are in control. You know, this is just me. I don't look at advanced decline, okay, and that's, don't worry, that doesn't discredit advanced decline. You know, the goal of some investors is they're just trying to find the relative strength, okay? Whether you got the advanced decline line higher than the neutral range or sellers in control, some people like to watch that. This portfolio is just looking for relative strength, period, in any type of market, okay? And or weakness to play that downtrend. So if that's what you're saying, there you go. What I'm going to go ahead and do is click on Save Style, and you could type in that name. Now, when you go back to style, load style, you're going to see those right there. Okay, now let's kind of now work our way to a couple things. Speaking of, let's say, speaking of some stocks that have relative strength. So first off, this is why when we go to the Market Watch tab, and let me know if that helps you as far as seeing the study on the chart, okay? Saw the question, I just want to answer that. So I have gotten some questions on, hey, when the market goes down, does it really make sense to compare things to the SPX, even though the SPX is going down? Yes, because you still want to see the relative strength. And relative strength doesn't always mean that there's positive returns, okay? And that's a big one. Now, if we looked at the benchmark and said, okay, where is the benchmark this week? That's why on this sector list, we put the SPX is in there. And the SPX is up 4.5% for the week. Now, when you look at the other sectors, it shows the performance of those sectors compared to the benchmark. Now, there's only 2 sectors that did worse, energy and healthcare. Okay, so just like in any market, we're saying what sectors might outperform potentially the benchmark. Now, when you have a snapback rally like we've actually had, this is a pretty high number of sectors that have done a lot better than the benchmark. That's not normally the case, okay? The SPX is normally going to be in the middle of the list. This would probably tell us if the SPX is that low, that you had a pretty good snapback rally as of late. Now, so remember what we've been saying in the last couple of days. We want to look at the trend column. We got a number of XG sectors here in 2s and 3s. Some investors like to see 3s because that reversal is more materializing. 3 just means the price is above both moving averages. The second column we actually said to watch, which has been kind of coming along nicely, the 10-day whole counter, green background. We talked about what this meant. Okay, just means that the 10-day whole moving average is green. The number of days in that column represents the number of days the moving average has been green. Script's not guaranteed for accuracy or timing. Verify, have an understanding of what it's looking at, and try to see if it can help. Now, the thing that we said third to watch is if we're starting to get more of a reversal, we should see the 20-period moving average. Now, just since yesterday, these are starting to turn green a little bit. Okay, what's your favorite color? Many investors say green. And so we're starting to kind of see more confirmation signs. And that fourth would be that moving average crossover. Do you realize, now this X right there just means it's crossing today or right now. X plus 1 crossed yesterday, X plus 2 crossed 2 days ago, and so on. Do you realize that when we always talk about 1, 2, 3, this is just it showing in a list itself. That's all it's doing, okay? And it's trying to show us on any list. Now, if I pulled up at the Dow Jones, if I went to, let's say, the public, and I went to Dow Jones Industrial Average, and I said, I wonder if there's any stocks that are actually showing. Now, here we are in the Dow, okay? Now, notice what we talk about doesn't change. It always concerns me when people kind of come up with a new idea of the week, okay? Notice when we look at this, 1, 2, 3, okay, 4. If we're talking about some entry signal setups, it better be because right there, okay, if we have any bullish type of setups, trends should be 2s or 3s. Now, does that mean that an investor cannot buy in trend 1? I've answered that 1,000 times. It's always the one person. You can buy in trend 1. You just better make sure that you're buying near a potential support area, and you might consider dollar cost averaging. Because if you're in trend number 1, sellers in control, and you're kind of hoping that it's going to bounce, you don't have any confirmation signs. You're buying on a price level, okay? So 1 is kind of dangerous a little bit because there's no signs of bouncing yet. You might have a tail. You might have a support level, but it's early, and that's risky, okay? Now, if the investor says, I want to see at least a diagonal breakout, that's what a 2 is. And if someone says, I want to see a little bull flag, okay, that's 3. So that's kind of looking for more confirmation, okay? Now, one of the stocks, so if we were going to look at, let's say, in the Dow, is there any stock in the Dow that's kind of shown a little relative strength? Anything? Any stock in the Dow that's maybe showed a little relative strength? Well, now, by the way, how could we see that? Well, if I click on this RS5 and I said, hey, what stock has really kind of shown some relative strength in the last, let's say, 1 day? Now, this RS5, this is the stock's performance compared to, in the last 5 days, compared to the S&P 500, okay? And what you're going to notice is we see Goldie Sachs. You're going to see a little Visa, Wally World, IBM. Can I get a Philip, Procter & Gamble? And so I want to go back to just real quick a sector that has actually done fairly decent. Now, if you look at the financial sector, you're going to kind of see that we broke apart in the financial sector right about 584. Now, if you're a bear, clearly you want to stay below 584. But wait, if we're getting above 584, warning sign, bears losing control. Now, one of the things I've seen over 25 years of doing this is once bears sink their teeth into a bear's position, they very rarely admit defeat. They very rarely say, hey, I am a bearish trader, but the trend is not going in my intended direction. I'm going to get out of here so I don't get ran over by the stampede of bulls, okay? Now, if we looked at the financial sector, one of the stocks in that financial sector is Goldman Sachs. Now, if you look at Goldman Sachs, it went through the earnings already. Now, that earnings was pretty solid. The estimate was $12.70. Their actual was $14.12. The last earnings was only $7.99, and you're going to see that that was a pretty big jump from one period to the other and the previous one above that. Now, remember, in a more volatile market, some investors might really choose more selling type strategies, define risk, What's the bad thing about that? It doesn't have as high delta as many of these other strategies like stock positions or long synthetic or long calls. Okay? If the investor is saying, look, there's more volatility, I want to try to take a bullish trade, but just not be as sensitive to direction, they might choose a long call vertical and a short put vertical. Okay? So if the investor said, my favorite strategy is a stock position or a long call, that's nice, but you got to consider the market condition. The market condition might dictate the strategy that you're picking and not vice versa. Okay? Now, what I'm going to go ahead and do is let's go to the trade tab. And on this, what we're going to do is we're going to go back to that margin account that we talked about yesterday. I tell you what, that short volatility position from Friday has really been, it's quite nice. Okay? That's not a recommendation, but that's why that balance kind of swung back the other way. Okay? Now, what I'm going to do is I'm going to go to the trade tab for just a moment, and I'm going to bring up GS. Now, what we're going to do in this case is we're going to go, now, as we talk about options, it makes a lot of sense probably not to have everything, if you considered options, in the same expiration. Because if we did all the option trades in the May 2016 May expiration, and in the next month, the market is horrible in terms of a downtrend, and all the positions are in that expiration, well, it could be ugly, okay? And you run out of time. So what we're going to do is when we talk about examples, we're going to make sure that we're kind of putting on some trades for May, the monthly options, but also the Junes as well, okay? Now, we're not discrediting weekly options. We're just going to try to focus on the monthly options as a starting point. Now, what I'm going to do is I'm also going to bring up, kind of go this, let's put that right there, a little drop down. Now, I'm going to bring up, we got the calls on the left, puts on the right. We're going to go down and look and see, can we? Now, what I'm going to do is, if you don't mind, I'm going to change one of these to open interest, that Vega column to open interest. So if I looked and kind of saw, and let's open this up with just a little bit more to kind of see what's going on. If we looked at picking a strike price with a delta of 30 to 40, that's usually a couple strikes out of the money, it might be the 500 or the 495. The 500 has 623 open interest, okay? And the bid-ask spread is about 45 cents. Not completely unusual when it's a bigger dollar stock or a liquid. This is more bigger dollar stock. What we're going to do in this account is we're going to sell the 500 and then buy the 495. Sell the 500, buy the 495, and then there's the credit. Now, the good thing is it's a credit. The bad thing is it's only $152, but the max risk given the vertical is really $348. Now, as an investor, you're looking at numbers, okay? And so the numbers that we would run is we would say, let's compare the potential gain of the vertical divided by the potential loss of the vertical, and you get what they call return on risk. Some investors want a minimum of 20%. Other investors say, you're out of your mind, I want 30. And some other investors say, if it's a little juicy, okay, maybe it's 40%. 40% or higher doesn't necessarily mean it's better. It just means that it's forecasted to be more volatile. And if it's forecast to be more volatile, the premiums are bigger. Bigger premiums equal lower break evens. The investors short the 500, they're getting a credit for $1.52, and you got, at least at this point right now, a break even of $498.48. So that gives the investor about $16 of wiggle room if it were to go down. Now, we would never think, oh, that's a lot of room, because you could drop down that in a day, okay? And this is where you also want to kind of have an understanding of what is the likelihood of the stock to close below the break even. Now, we don't have a 498, but we can extrapolate, okay? Well, that odds, if we said maybe 498, if we had a strike in the middle, it's probably about a 36% chance, 35% chance that it could close below there at expiration, okay? Now, I hear like a little thing in my head saying, explain what delta is. Remember, delta really has two main meanings. The change in the option price given a change in the stock price by $1. Another way you could look at it is approximate probability of the stock closing below that strike price on the puts we're talking about, closing below that strike price by a penny, okay? So that means there's a third of a chance to be below the break even, 2/3 chance to be above break even, okay? Now, what you're now going to notice is that trade fills and it's sitting right there. Now, the comment is from Luke is, okay? Now, Luke actually says, what about the resistance at 524? Well, this is why I was kind of showing the sector. If the sector is breaking inside its old channel area, a couple of the bigger dollar stocks might break inside that old channel as well. Now, what are some of the stocks that contribute the most to the financial sector? JP Morgan, Goldman Sachs, and so on, right? So we're kind of thinking, could the sector drag up Goldman Sachs? Okay, so that's why we're kind of saying, hey, could the sector lead and cause Goldman Sachs to come up with it? Now, Luke, I am not saying that that's not a potential level of resistance, but that's kind of why we chose a vertical strategy. If the investor was so concerned about 524, they might say, I'm going to wait to buy until we get above 524, or maybe just do a strategy that's not as sensitive to consolidation. If this stock sat here for the next 30 days, it's not the end of the world, okay? It's time decay positive. Now, I want to also go back to just real quick, one of the stocks that is just blowing my mind, okay, is Berkshire Hathaway. Warren Buffett probably doesn't need any more money, okay? Now, maybe he does. Maybe he feels like he does, okay? Berkshire snapback rally right back to the upside, which is pretty amazing. Now, I want to also speak about JP Morgan for just a second. Now, on Thursday, we did an example trade of going bearish JP Morgan. Now, some of these stocks, when you take a look at them, they kind of look like if we went to where the current price was to this prior level, to that prior level, to this prior level, it kind of looks like we're at a level of resistance. Would you agree with that? Would you agree that the investor might say, James, if JP Morgan was going to maybe break out higher, one of the telltale signs potentially could be that we actually break above 236. We start maybe a big green candle above that and so on. Doesn't have to be on high volume, but if it was, that might even be a stronger sign that that breakout is occurring. Reversal, in other words. Well, the reason why we bring this up is we did a JP Morgan trade thinking that maybe could this stock break down on earnings. Now, has it been horrible? No. Sold the Ford to the 240, wanted the stock to stay below the 240, and then bought the 245 for protection. Now, what is this trade? Well, this trade right here is really a short call vertical. Now, most of the time, I'd probably say 95% plus or more, we like to let the trades play out the probability. But if the investor said, James, I don't like where this stock is, I think there's a good chance that this stock could break to the upside, we're going to set a conditional order on this. And what do you think that conditional order is? Well, we're going to say if that stock gets at or above a certain price, be willing to exit the trade if it gets above a certain price. Why? Well, the investor doesn't want to maybe take a max loss and they think that reversal might continue. Now, if we went back and said, okay, what price are you thinking? Now, what I'm going to do is I'm going to say, look, if we get above about 240 and a half, exit the bearish position. Now, this is no different. A bullish trader says, look, exit if we break support. And we've talked about that 100 times, at least. Now, a bearish trader is saying, look, if we get above resistance, exit the bearish trade. Same idea. So what I'm going to do is going to go to the trade tab. We're going to right click on these lines, create closing order, and we're going to say exit it. It's pending. Now what I'm going to do is the exit of this position is pending on the stock price. How do you do that? We're going to go down to limit, market, day to GTC. All right, that's not too bad. Okay. Now, so how do you do it off the stock price? How do you make the exit based off the stock price? Well, it's simple. Click on the gear. And if I click on that gear right there, you're now going to see that if we go to right where it says symbol, now I'm not going to type anything. The only thing I'm going to do is right below symbol, I'm just going to click on that box and it automatically comes up JP Morgan. I click below the method box, it automatically comes up Mark. Now this is the confusing part, okay? Some people are not good at this, okay? And that's okay. And sometimes it confuses me, and I always have to kind of just read through it a little bit, logically think through. Notice that little sideways V is pointed towards JP Morgan, okay? So as that sideways V is pointed towards JP Morgan, they're saying the stock price of JP Morgan is greater or equal to 240. Now, you said, James, that doesn't help me a lick. I need to read what it's actually confirming or what I think it's doing. Mark price of the security is greater or equal to 240. Thank you. I need to confirm what I thought. That's okay. Now, what we're saying is if JP Morgan gets at or above 240, shut that position down. Now, does everyone need to do that? No. In this trade, we're going to show that. So if we kind of start to see the financials reversing a little bit more, it's going to shut down that bearish position. Confirm and send. And now this is pending. What do you mean pending? Well, just think of it as it's not a stop, but it is a similar to a stop. It's a trigger to exit. Stop is a trigger to exit as well. A stop doesn't guarantee an exact price level that it's going to fill at, okay? But this is saying this is like a stop, some similarities that it has a trigger price, but we don't know where it's going to get filled at in terms of the option prices, okay? So there are some similarities between a stop and a conditional order. Now, what I'm going to go ahead and do is send the order, and that's important because a lot of times, you know, people put on bearish positions and they don't really watch them. Speaking of that, I need to go to the next one, okay? Nike. Now, if I were to ask you a question, what is the trend of Nike? What would you say? Trend of Nike. What do you notice? Now, as I'm getting an answer to this, what would give us maybe some signs that maybe that bearish trend was starting to reverse? What would give us some ideas? Okay. Now, if I kind of zoom in on this, you're now going to notice that the 20 period moving average has really been on fire really for a long time. That 20 period moving average is right here. Okay. And it's just been going down, going down, going down, going down, going down. And so it's been sliding and sliding. Now, there has been a little 1 day up on the 10 period moving average, but it didn't last very long, okay? And if we go to where we are now, you're now going to see that the 10 period moving average has gone green, and it's been green for 1 or 2 days. What's the position? Funny you should ask. Well, if we go to, let's say, the Nike position, why are we talking about this? Well, so first off, you got a long put here. Now, a long put gains in value, let's say 2 main ways. What are those 2 main ways? Okay, so that long put position, okay, bought the put at 72.5, and we bought it at $3.30. Okay, and now that put is increased in value to $17.82, or in other words, 440% gain, or in other words, dollar amount, $1,452. Now, if you take a look at that, the investor could say, look, I'm going to exercise my right to sell the shares of the stock. Now, wait, if you did that, are you long the shares or short the shares? This is important you understand this. If we right click on that line and we say exercise, you're now going to have plus 100 shares. No, you're not. You're going to be short 100 shares of stock. Now, we're in an IRA account. Can you be short shares of stock? Denied. No, you can't. Not an IRA, okay? So we cannot exercise, okay? So if we can't exercise, because we can't go short, what else could we do? Well, we could consider closing the position out. And so what we're trying to do is we bought it for actually $3.30. We're going to try to sell for $17.82. We're going to right click on that line Okay, create closing order, sell. Now, what we're trying to do is take that $1,452, say, spank you very much, the investor says, as Hannah would say, never would take her words out of her mouth. And we're going to go ahead and say, look, we're going to try to sell this. Now, do not just blow through this. Look and see where the mid price is. Now, the closer you go to expiration, the harder the fill might potentially be as liquidity dries up a little bit. We're going to confirm and send. Note the commission there as well. Send the order. So if the stock goes down, the long put could make the most amount of money. It's more directional. This right here is what type of strategy? Well, that's your short call vertical. So we did a long put and a short call vertical, and that's really like you could say that's really like a short synthetic, but it has a capped loss. Now, if we looked at this and said, wow, the short call vertical, yeah, it made 99%-ish of the maximum gain, but it didn't have anywhere near the gain that the put had. Well, that's true. Okay, the put actually could benefit more if the stock were to drop a lot. When was the trade placed? It was placed about a month ago, and the stock slid. Now, that trade helped this portfolio about $1,600, okay? Now, we're going to right-click on that, create closing order, and then buy that back, okay? Confirm and send, note the commission, send the order. Now, why are we getting out? Well, number one is we're out of time, and number two, we're kind of sitting here very, very neutral. We're not really breaking down below a support area, and there's starting to become some signs that maybe could 52 really become a potential support level. As a bearish investors, you don't want support levels, you want fresh, new lows. Now, are there any questions with that? So now remember, that goes back to buying puts, which we've talked a lot about. Second, it goes back to short call verticals, bearish strategies. When you combine a long put and a short call vertical, it's short synthetic like. Why do I say that? Well, if you truly did a short synthetic, sell, and you went to a sell synthetic, okay? The reason why it's not a true short synthetic is a short synthetic is when you sell the call, okay? You sell the call. The problem is then with that is there's no cap, there's no max loss. It has infinite max loss. When you do the exact same strike prices, the delta is going to be negative 100, okay? This is very important you understand this and why we do it the way we show. When you sell a call, okay, and you buy a put at the exact same strike price, the delta is 100. If the stock goes down $1, the position could make a potential $100. Why does it show positive negative delta? Well, because the delta is showing that the stock went up $1, the position could lose $100 or have an unrealized loss. Now, so to offset this risk of unlimited max loss, we make it a vertical and not just a short call only, okay? So the delta is not going to be 100. It will probably be between about 50 to 60-ish, okay? So it's similar to a synthetic, but it doesn't, the delta is not as negative. Does everyone understand that? So if I brought up this position and said, hey, could we just show me what this looks like if we did this, like a new one, compared to what you just showed? Sure. If I did a short call vertical, there it is. And then next, we came in here and just said, we're going to buy the put. What does that look like on the diagram and the delta? Well, pull it up. Here we go. So if we look at this, what you're now going to notice is we just have isolated down here the short call vertical and the long put. Now notice if the stock were to go to the upside, the loss is not infinite. The loss is capped at a certain point if the stock were going to go up. That would not be the case if you just sold the call by itself. Selling the call by itself is a naked call, meaning unlimited loss potential. By buying the call above us, it caps, okay? It caps the risk. All right, there it is. So as I recheck that, just want to double check something. Those numbers, 55, yeah. I want to double check that. The diagram is going to be the same though, but I'm just kind of looking to see, oh, I know what it is. I'm in the paper money account, and so the diagram throws off. But if you went to that, and that's why I use this. If I went to that, let me just pull this up so it just be 100% clear, because that stock price is off. So I'm going to pull this up just quickly. In this case, do a 57.5. There's a short call vertical, double check. Yeah. Step 2, I'm going to buy that call, buy the put, something like that. This diagram is going to be more in line with what we were saying price-wise. And so if I pull this up, there it is. That price right there, double checking. Okay, there you go. So now what you're going to notice is here's the stock price, okay? Why does that line flatten off right there? It's because you bought you bought the 57.5 call that creates the max loss, okay? So the short call vertical there and the long put. The stock actually were to go down, if the stock actually goes down, the potential is capped if the stock were to go all the way to zero, okay? And that's why that line keeps going up. Now, that's a very important point because puts could come back to married puts on stocks. It comes back to callers. Puts come actually back to, let's say, if you did a short synthetic. Puts are not just one strategy only, okay? Now, the comment is, why not use a synthetic with protection? Well, if we, for example, I'm going to go back to something just real quick. If I went back to, let's say, example given, I'm going to go back to the stock example of Philip Morris, okay? So on the example of Philip Morris, what you're now going to notice is, we talked about this yesterday, but I'm going to talk about it again. If I said, hey, I'm going to buy the shares of, let's say, Philip Morris, okay, PM, okay, let me show you what this looks like. If we go to the trade tab and we click on the ask price, okay? Now, when we talk about doing this is, if we did a caller position, came down to first trigger SEQ, clicked on that, and if the investor said, James, what I want to do is I want to sell a call above where we are. Well, if you did that and you're buying the shares, that would be a covered call. If you went to sell and you went to caller synthetic, you could actually say that, so the caller is implying that you really have the shares, okay, or buying the shares currently. So the synthetic is you do not own the shares, okay? In other words, synthetic meaning the profit loss diagram is mimicking a stock position, but you don't have the stock. So if we said we have a caller, that's telling us that we're buying the shares or we have the shares. If we said we have a synthetic position, we really have a right and obligation, which is replicating the profit loss diagram of a stock position. The difference is, okay, the synthetic does not have the claim to the dividends, okay? Now, if I went in here and said, look, I'm going to do a caller position, you're now going to see that we're selling the call there, and then you're buying the put, let's say example given at the 155. So if you use callers, you're going to see that word synthetic right next to it, okay? So if we actually said, well, James, if I did the 165 and the 155, that's a synthetic, but you can't say that because if we're buying the shares too, then this is really a caller, okay? All right, now, I got it in 1 minute. Let's kind of do a 60-second update. A couple stocks we're going to keep an eye on. Keep an eye on actually GD. That's a stock that's maybe trying to get above an area of resistance. Another stock that's trying to maybe get a cup and handle potential breakout on an intermediate to long term. Keep an eye on Coke. Its counterpart for actually the Coca-Cola European version did break out. Mo is another one that's trying to get a little reversal that we've talked about. Keep an eye on Netflix. That's another stock that's up pretty big here today going into the earnings. Palantir, that's another stock that's right up back near the prior high. Could that reverse? and CrowdStrike. That's a stock that's poked its head above a level of resistance. Okay. Now, by the way, last one, we'll just point this out. Costco. Okay. Talked about this yesterday. Costco kind of at a critical juncture. Can it get above that 989 threshold? Keep an eye on those. But there are a couple stocks that are trying to reverse higher here, and that's what we focus on here today. Now, my focus was I really wanted to kind of talk about some positions that we had in the portfolio, which we did, and we also want to talk about some new examples, which we did as well. Now, stay tuned for Cameron coming up right after, and also want to thank Barbara for answering your questions in chat. She will be later on teaching on technical analysis later today, so join her as well. And also want to give us a quick reminder that with what we discussed, it was done for example and illustrative purposes only. And this has been the class on Investor Master Series with discussion on stocks and options. Stay tuned for Cameron coming up next. Thanks so much. Take care. Bye-bye.